Stocks in Asia followed the US equities lower after that hawkish statement. The dollar fell, treasury yields stabilized after briefly touching the 3% mark as well. But what does this whole scenario of more rate hikes than anticipated mean for global markets, more specifically emerging markets like India as well? Let's find out the global market picture and the emerging market picture from Adrian Mowat, veteran emerging market strategist who joins us from Hong Kong, and Geoffrey Dennis, head of global emerging market strategy at UBS Securities, who joins us from Boston. Gentlemen, both of you, very good morning or very good evening, as the case may be, to each of you. Thank you so much for taking the time out and speaking to us at Bloomberg Quint India. Adrian, let me start off with you. Did this come as a big surprise, or was there a lingering feeling that there will be a change from 3 to 4 this time around?
I don't think it did come as a big surprise. I was just looking through the stats in terms of what the futures markets was forecasting, and there doesn't seem to be a big change in what was forecast for where rates will be by the December meeting, let alone the January meeting. Perhaps it was the tone of the Fed in terms of their confidence that the rates would continue to rise and their optimistic statements around the economy that might have taken markets by surprise. I think there's also a dynamic here where, market confidence is relatively low. When you look across the performance of markets year to date, the US market's up a bit, China's up, but many other markets are weaker. Even the sectors that should be beneficiaries of higher rates, like banks, don't seem to be performing particularly well at the moment. So I think the markets perhaps are telling you a little bit more about their weakness rather than really indicating a change of view with regards to the Fed.
Geoffrey Dennis, it's not just about the 2 hikes now, the mean rates that everybody expects in FY19 also, all of that signal towards, if not faster, then more rate hikes than what the market would have presumed. Is it essentially due to growth or due to also a belief that inflation is right around the corner? And therefore, what does it do to yields in the near term in the US?
I don't think it's because inflation is assumed to be right around the corner. I think what the Fed is doing is ensuring that they've got some insurance out there, if you like, in case inflation does pick up more than anticipated. But I think the key point is Adrian's got it absolutely right. I think the market was sort of hovering between 3 and 4 rate hikes this year. We at UBS had 4 rate hikes in our forecast. And frankly, we think the market has overreacted to this because at the end of the day, we haven't changed our interest rate forecast on the back of this. And I think, as I say, I think all the Fed is really doing is just telling the world that they are comfortable about what the economy is doing. The economy's clearly picked up, and they just want to be signaling clearly to the market that in the event that inflation does surprise to the upside, they would be willing to do more. But at the end of the day, as I say, our forecast is still that rates will have no different a peak than we thought they would have this morning. And so we fully expect this little bit of bearish sentiment here that's come out of this meeting to subside probably relatively quickly.
Interesting. Adrian, one thing that you got to give credit for to the Fed now, they're wanting to be a lot more open about what their thought process is. And maybe that's why this move to having a Q&A after each of the policy statements as well. Now, my question to you is, if indeed the Fed is preparing the markets well for what it would do, and if indeed the economic factors are the big reason behind the rate hikes as well, a rising US economy, falling employment, etc., would all probably augur well for the equity markets. And if indeed the US markets are slated to do well, if they do, they will not do that in isolation, right? Emerging markets, by and large, would also follow suit.
Well, no, I think the story of 2018 is that emerging markets are not performing in line. There's a big divergence of performance across the emerging world. So some of the simple commodity-related markets, the Perus, the Colombias are doing very well. You've got okay performance out of China, although much of that happened in the month of January. And then if you go to the other extreme, you've got markets such as Indonesia, Turkey, the Philippines down double digits, and a market such as Turkey, particularly vulnerable to rising funding costs. And as the Fed moves rates higher, you see that funding costs are not just moving up in US dollars, they're moving up in other currencies. So yes, I accept your point that a good U.S. economy is broadly good for global capital markets. But then when you look at the specifics that you invest in, we've got a story where the tech-heavy markets of North Asia are doing okay. I think for China, there's an interesting divergence in forces at work there. The Chinese economy looks okay, earnings look okay. But if you look as U.S. rates are moving higher, we're seeing monetary conditions in Hong Kong tighten, with HIBOR at a 10-year high. And that having a little bit of pressure on the Hong Kong Stock Exchange, where many of the Chinese companies are listed. So yes, generally when the U.S. is doing well, that's good for global markets. But remember that the forces at work here are having a diverging effect across the emerging market asset class.
Right. Adrian, let me rephrase my question. I mean, what I meant to ask you was was that the belief at the start of the year was that if the rate hikes are faster than what people anticipate, then there will be carnage in the emerging markets, bond markets and equity markets. And the developed market world and maybe the US will see substantial fund inflows. We've seen part of that playing out because of the underperformance of the emerging markets hitherto in the year. If indeed the US economy were to do well and the markets were to do well, will we not see carnage in the emerging market pack despite the differential in yields? That's my moot question. Part two also is that a lot of emerging markets have started raising their rates as well. India, case in point, Indonesia, case in point, China, case in point.
Yeah, so look, I think the word carnage is very dramatic. We have seen double-digit declines in a number of emerging market equity markets. There has been significant weakness in a few key currencies where I look at what's been going on with the Turkish lira, the Indonesian rupiah. Let's also be conscious that the Indian rupee is only about 2% away from its all-time low versus the US dollar. So there's definitely pressure out there. And I think markets are probably quite a long way into discounting the impact of higher rates and a slightly stronger dollar. Now, whether that leads to more dramatic events, I think really we've two factors at work here. As you highlight, the global economy is relatively strong, which should be good for corporate profitability and their ability to service debt. However, this increase in interest rates and funding costs in EM combined with weaker currencies may mean that there are a few borrowers out there with mismatch with domestic revenue and international liabilities, and perhaps that's where you begin to see some of the strain.
Geoffrey, Dennis, one final question. Actually, two questions roll into one. This whole talk of this inverted yield curve and the historical signal that has given. Now, everybody's talking about September and the possibilities that if there is the hike in September, then we definitely see the inverted yield curve, if not already. And part two of my question is the ECB signals, the likely ECB signals today evening, and what that does in addition to what the Fed has already done.
Yeah, fine. Let me just add one thing to what Adrian said. I think the thing that you should add to the mix in terms of this conversation is that emerging markets do well when global growth is good as long as the dollar is going down. And that's what we had in 2017. And that was a perfect cocktail for EM. Now we've got a more challenging dollar environment. Dollar's been going up. And so then what happens then is even though you've got stronger growth, as bond yields back up and as the dollar is stronger, what it does is allow investors to pick over some of these weaker markets. And that's exactly what's happened this year with the weakness in Turkey, more recently the weakness in Brazil, one or two markets getting challenged in Asia as well, India, Indonesia, as has been said. So I think we've got to bear in mind the dollar environment is very different. Our view at UBS is that the dollar will go down again later this year, which will create, in our opinion, a better environment for EM. On to your specific question, we're not particularly bothered about the inverted yield curve. I mean, typically when inverted yield curves really cause problems is when inflation really takes off, and that forces aggressive tightening by the Federal Reserve to really choke the economy off. That's not going to happen this time. Yes, the yield curve will flatten a bit more. Bond yields will stay relatively contained in our view, but you're going to see controlled tightening. So without there being a big spurt in inflation, you don't have an aggressive Fed tightening, and that doesn't therefore signal a recession, although clearly people are very worried about that. I get it. And on the ECB, we think the ECB is going to do nothing very much tomorrow. We think they're more likely to signal next meeting they'll extend QE for a while longer. But at the end of the day, we still think they'll start tapering around the end of the year, and we think they'll start to raise rates about the middle of 2018. And that gradual tightening at the margin of monetary policy in Europe is one of the things that we think will eventually bring the dollar down, and that's the sort of thing that will eventually suck money out of the U.S. market, perhaps elsewhere, and in that environment, emerging markets can make some sort of recovery.
Okay, gentlemen, really appreciate you taking this time this morning and this evening, respectively. Adrian Mowat, Geoffrey Dennis, thank you so much for taking the time out and speaking to us.
Thanks very much.